Hello, my name is Jennifer Fernandez and I'm part of Group H. I'm going to be talking about mortgages. The first thing that I'm going to say about how to get a mortgage loan is you need to know the 3 steps before to find the right mortgage for you. The first step would be estimate how long you expect to live in the house that you're planning to buy. If the answer is less than 3 to 5 years, consider an adjustable rate mortgage, ARM, which typically starts out with a lower rate. If you plan to live in your new home longer than 5 years, a fixed rate mortgage offers protection against rising interest rates. Number 2, shop around for mortgage rates. Banks, credit unions, and mortgage companies all offer mortgages. Compare at least 6 lenders in your area. Number 3, add up all the costs for each lender, includes fees, points, closing costs, etc., to arrive at the total mortgage cost for each lender. The first step in acquiring a home mortgage is to gather the information you need to include in a mortgage application. Review your credit report by ordering a copy from the credit bureaus used by local mortgage lenders. Pre-qualify for a mortgage lets you know how much you can afford and makes you a more attractive buyer. Conversion on mortgage limit housing costs to 28% of gross income and total debt payments to 36% to 36 income. Mortgage terms are usually 15 or 30 years. The longer the term, the lower your monthly payment will be, but the higher your overall interest cost. 30-year loans often permits additional principal payments. One additional monthly payment per year will reduce a 30-year loan to 22 years. Interest rates are fixed or variable over the term of the loan. Variable rates may be best for buyers who plan to sell within 3 years. Generally speaking, 1 point is worth 1/8 of 1% of the loan rate. A balloon payment is a lump sum payable at the end of the specified term. Points and interest on mortgage or home equity debts are usually tax deductibles. Financing the American dream. To do this, the first thing you need to do is buy a home is the biggest financial investment most for us will ever make. As with any large project or goal, it requires dealing with a variety of complex issues. The best approach is to divide the process into manageable tasks. The following deals with the first step of gathering your records, determining what can afford and understanding mortgage options. Put your own financial houses in order. Before you go looking for a home, you should determine how much home you can afford. Most lenders will pre-qualify you to borrow up to a certain amount. Pre-qualification allows you to focus on a realistic price range and makes you a more attractive buyer. Whether or not you want to pre-qualify, eventually you need to complete a loan application, and it may take some time to gather and assemble all the required information. It's also a good idea to review your credit report. Contact lenders to determine which credit bureaus they actually use. Then contact the credit bureaus yourself and request a copy of your credit report. In most states, credit bureaus are required to provide individuals with a free copy of their report. Review your report to ensure that all information is correct. If you have past credit problems, don't lose hope. Be prepared to present a rationale for each slip-up and demonstrate an improvement in your ability to pay your bills on time. How much mortgage you can afford. The Federal National Mortgage Association, Fannie Mae, is a government-sponsored organization that purchases mortgages from lenders and sells them to investors. 2 income-to-debt ratios established by Fannie Mae are standard requirements for conventional mortgages. The first requirement is that monthly mortgage principal and interest payments, P&I, plus insurance and property taxes, cannot exceed 28% of the buyer's gross monthly income. Some exceptions may apply to increase this limit to 33. The second requirement limits total monthly debt payments, house, credit cards, car payments, etc. to 36% of gross monthly income. In addition to these requirements, you may have to pay 10 to 20% down on the total purchase price to qualify for a conventional mortgage. Types of mortgages. How much house you can buy depend also on the mortgage terms and interest rate. The term is the length of time, usually 15 or 30 years over which payments will be paid. The rate can be fixed, meaning it doesn't change over the loan's term. or it could be adjustable. It fluctuates with market conditions. 30-year fixed-rate mortgage remain the most popular. The longer terms lower the monthly payments, while the fixed rate provides stability over the life of the loan. Given relative low interest rates, these mortgages are attractive to buyers planning to stay at least 6 or 7 years in their new home. The drawbacks are low principal payments in the early 15 years, and the risk that market rates will decline over the term. However, if your credit history is sound and you have sufficient income, you can usually refinance your mortgage when rates decline. A 15-year term lowers the interest rate, reduces total interest payments, and increases principal payments, but it also increases monthly payments. If you can't afford the higher payments now, you might opt for a 30-year mortgage. If there are no prepayment penalties, you can make additional principal payments as your income increases. Making just one extra monthly payment a year will pay off a 30-year mortgage in less than 22 years, and can save tens of thousands of dollars in interest costs. If you plan to stay in a home no more than 3 years, you might want to go for an adjustable rate mortgage, ARM. These offer initial rates that are lower than fixed mortgages. At some point, usually after the first year, rates are tied to market conditions and are subject to potential rate increases. Most ARMs include a cap rate of rate increases in any given year, as well as over the life of the loan. Some ARMs offer initial rates at least 2% below fixed rates and limit increases to 1% annually, and 5 to 6% over the life of the loan. Many homebuyers are attracted by the affordability of IRM during the initial period. However, you should be confident that the future income will be sufficient in both interest rates and your monthly payment increases. Another popular mortgage involves a balloon payment. A balloon is a lump sum payment that pays off the loan in full after a fixed period of time. Generally, the rate of balloon mortgages are 1.4% to 3.4%, less than a 30-year fixed mortgage. But during an initial period between 3 and 15 years, payments are very similar. After this period, the remaining outstanding principal balance is either due in full or subject to refinancing. This is a good option to homebuyers who plan to sell before the final payment is due. But because property values fluctuate, you may not be able to sell when you want. You may also face higher payments if you're forced to refinance at a higher rate. And there is also a risk that you may not be in position to refinance when the balloon becomes due. Interest rate points. Points are interest paid in advance to reduce the rate of a loan. 1 point is equal to 1% of the mortgage amount. The general rule is that 1 point is worth 1/8 of 1% of the loan rate. The decision to pay points for a lower rate is based on how much the seller is willing to contribute to points, how long you plan to stay in the house, and how important lower payments are compared to higher closing costs. You will need to calculate the long-term value of points based on these factors, keeping in mind that points are generally tax deductible in the year paid. You also have other alternatives. If you cannot afford a conventional mortgage, there are a variety of alternatives. An ancient seller will sometimes offer owner financing. Federal Housing Administration, called FHA, loans offer down payments as low as 3%, but may require the buyer to purchase a mortgage insurance. The FHA is a government agency responsible for ensuring affordable housing mortgages. The Veteran Administration, VA, offers no money down mortgage to qualified veterans of the U.S. military. Finally, there are local affordable housing advocates that offer low-cost, low down payment loan alternatives. For further information, contact the FHA, VA, Fannie Mae, or your local mortgage lender or real estate broker. Thank you.